Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Palantir Technologies, ticker PLTR. I know that this stock has had a roller coaster of a past. I do like the concept behind it and their growth prospects, and analysts seem to think that they got some pretty good growth prospects too. So what we're looking at here is a fair value of 728, which interesting. Lines up perfectly with the 52-week low of the stock. So I already know that anyone who got in at that point is happy. They've almost 3x'd at this point, but I think that they'll be sitting pretty well going forward as well, as long as things come in as planned. Earnings yield 0.75, showing that at the moment it's pretty elevated. Like I said, it's about 3x the fair value as of close today, and it's been as high as 27.5. So it is a stock that moves a lot. Cash flow yield looks incredible, 31.33%, usually 23.28. It's just getting better by the year. They don't pay a dividend. ROE is okay at 6%. We'd like something better. Investments didn't pay off, lost 4.9%. And assets, we'd really like to see double that. 4.6 isn't bad. I mean, I'd really like to see 9 plus. Debt to equity looks really good. They seem to have a strong balance sheet. Margins are insane, 80.6% this last year for the gross margin, usually around 80. And net, they were profitable, almost 10%. In the past, they haven't been profitable, and that is something that we really like to see. Margins look really good. Cash flows look good. Debt to equity looks good. Returns are okay. But now let's develop a thesis and see where we think that the fair value of the stock is going to be going. So it's grown pretty well, 13%, slowed down 5.3 over the last 2 years. Analysts are expecting it to pick back up to 21.8 this next year, and then 20.5 over the 20 comes in under those. This is the compound annual growth rate that we're expecting over the time frame that we're looking at. So I feel like 20 is pretty steep, and it will essentially double their revenues over the next 5 years. Share count, they do issue shares. Definitely not something that we like to see, but I think we can adjust this and say they've gotten better. I don't think they're going to have to issue as much shares now that they're profitable, and they have been slowing it down. So maybe 2% instead of going midway between the numbers that we have. Cash flows, very solid cash flow growth. They're already at a very high cash flow yield, though. It looks like that growth brought them up to this point. 30 would be fair to stay at, which would be 19% annual growth off those 20% revenues. So we'll stick with that, at least as our starting point. Assets, they're good, growing double digits, almost 12% over the last 2 years, almost 19 over the last 3. So 15 is definitely fair. I mean, it could be smaller now that they do have more assets, but if they're profitable and they can invest that into the proper assets and get a better ROA, that's what we'd really like to see here. Liabilities, basically flat over the last 2 years. They did shrink them over the last 3, so something small. Hopefully they're going to continue to shrink them. So let's go with 2% and see where that puts us. And then margins, this is assuming that they're barely growing their margins, 0.01%. I definitely think that they can get north of 10% with 80% gross margins. They could probably do better than that, something more of a 20 to 30 net from what we see in some of the other companies. But I don't know if that's going to be over the next 5 years. So if we stick 1% in here, it brings them just shy of 10% over the next 5 years. So maybe 1.5 would be more realistic. And with this scenario, what we're looking at is average annual returns just north of 17.5%. So if you buy at today's price, you're paying a pretty large premium. Current value 728, 17% annual growth on 728. I mean, it sounds like a large percentage, but that's not even 10. At $10, 10% would be a single dollar. So That is something to keep in mind. In 3 years, we'd be looking at 873 for the fair value, and in 5 years, 1208. So I do really like the growth. I do really like the metrics, but it is at a very elevated price right now. Definitely not something I'd be willing to pay. We'd want to get in at least the fair value, if not better. Ideally, the margin of safety, get in at 5, and you'll be sitting great. Almost 3x returns in 3 years, and somewhere between 2 and 3x returns in 5 years. So now we can take a quick look at everything valuation-wise graphed out. We look at the earnings, the cash flows, the balance sheet, the actual share performance, and then we stick in our fair value based off all of those. So earnings started out very negative on a great trend upwards. Some nice linear growth there. That is what we like to see. The fair value on a nice linear trend as well. Definitely not as steep, but it is surpassing a lot of the other metrics in our time frame from 2022 to 2024, and on a very nice trend. The balance sheet is kind of flat. We do see it moving up to the left, but not as much as some of the others, and that's why the fair value is surpassing it. Assuming our thesis, it's going to be the lowest factor to the valuation going forward. And then just above that is the cash flows, which follow a pretty similar trend, at least as of 2022. Pretty flat, but definitely some direction upwards towards the left. And it did bounce around a bit in the early 2020s. And then we have the share price, which has consistently been well above all of the valuations. It looks like it was closest back in 2022. And let's see, in 2022, it was right around $10, which I think if you factor in a premium to the valuation, 5 to 10 would be a decent range to get it. I would definitely go in heavier at 5 or lower. At 10, I wouldn't mind starting to buy. But what we really don't want to see is some separation like this, where the share price is just outpacing everything because there's small growth in the balance sheet and the cash flows. If they can improve their margins and bring up their revenues, the earnings are going to go pretty far. And that is what at least currently, the share price is tied closest with. We can take a look and see if there's anything we want to alter here. I think that revenue number is pretty fair. If they come in shy of that, we can see if they only come in with 10% growth, still double digits, still pretty good. But if you buy in at the fair value, at that point, you're basically buying it at the 4 to 5 year valuation. Share count, I'd love it if they could stop issuing shares altogether. And that right there is a huge boost. Even 2% is a massive drain on your returns as an investor. Cash flows, I don't see them continuing to grow the yield. 30% is definitely reasonable. It's one of the better ones that we've seen. Continuing growth from there is going to be very difficult. We can take a quick look at the balance sheet. Some great asset growth, lots of tangible assets. That's what we like to see. Tangible book value is larger than their liabilities. That's the ideal balance sheet here, and we see that very rarely. I'd give a larger weighting to this stock. And then margins. I feel like this 1.5 is a very reasonable case. So what I'm looking at for this stock is come back down. It's just at really high valuations right now, almost 2x what it should be. And I'd consider it closer to 10. I would buy close to 7.5, and I would go heavy buying 100 plus shares closer to $5. And that's what I would be doing here. Now it's one of those growth stocks. I wouldn't bet on it going down. I wouldn't sell calls or call credit spreads because just the volatility, there's high risk there. But wouldn't mind selling a put closer to $10. And that's all for this one. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.